Hello and welcome to Finance Walk. In this video, we'll cover annual reports analysis part 2. In last video, we covered balance sheet and income statement analysis. And in this video, we primarily will cover cash flow analysis and how to read footnotes. Okay, so we'll see what we are going to cover in this video. In this chapter, we'll cover cash flow analysis and footnotes, how to read footnotes. Okay, cash flow analysis. What is meaning of cash flow analysis? Cash flow statement is a financial statement that shows a company's incoming and outgoing money during a time period. The statement shows how changes in balance sheet and income accounts affected cash and cash equivalents, and breaks the analysis down according to operating, investing, and financing activities. As an analytical tool, the statement of cash flows is useful in determining the short-term viability of a company, particularly its ability to pay bills. There are three activities primarily: operating activities, financing activities, and investing activities. Operating activities include the production, sales, and delivery of the company's product, as well as collecting payment from its customers. This could include purchasing raw materials, building inventory, advertising, and shipping the product. The amount of cash flows arising from operating activities is a key indicator of the extent to which the operations of the enterprise have generated sufficient cash flows to maintain the operating capability of the enterprise, pay dividends, repay loans, and make new investments without recourse to external sources of financing. So this cash flow, operating cash flow, is a key indicator, especially to check operating capability of the enterprise, pay dividends, repay loans, and make new investments. Okay. Cash flows from operating activities are primarily derived from the principal revenue producing activities of the enterprise. I repeat, cash flows from operating activities are primarily derived from the principal revenue producing activities of the enterprise. Therefore, they generally result from the transactions and other events that enter into the determination of net profit or loss. Let's see example of operating cash flows. Receipts from the sale of goods or services, receipts for the sale of loans, debt or equity instruments in a trading portfolio, interest received on loans, dividends received on equity securities, payments to suppliers for goods and services, payments to employees or on behalf of employees, tax payments, interest payments. Alternatively, this can be reported under financing activities in IAS 7 but not in US GAAP. Payments for the sale of loans, debt or equity instruments in a trading portfolio. Items which are added back to the net income figure, that is, which is found on the income statement to arrive at cash flows from operations, generally include depreciation, deferred tax, amortization, any gains or losses associated with an asset sale, that is, unrealized gains, losses are also added back from the income statement. After operating activities, let's see what are investing activities. Investing activities include the cash flows that represent the extent to which expenditures have been made for resources intended to generate future income and cash flows. I repeat, investing activities include the cash flows that represent the extent to which expenditure have been made for resources intended to generate future income and cash flows. Let's see examples of investing cash flows. So examples of cash flows arising from investing activities are: first, collections on loan principal and the sales of other firms' debt instruments; investment returns from other firms' equity instruments, including sale of those instruments; receipts from sale of plant and equipment. Fourth is expenditure for purchase of plant and equipment. Fifth is loans made and acquisition of other firms' debt instruments. And lastly, expenditure for purchase of other firms' equity instruments. So these are the activities which are included in investing cash flows. Okay, now let's see which are the items under investing activities. So items under investing activities include capital expenditures, which include purchases and sales of property, plant and equipment, and secondly, investments. Okay, now after covering operating activities and investing activities, let's go to financing activities. So financing activities include the inflow of cash from investors such as banks and shareholders, debenture holders, as well as outflow of cash to shareholders as dividends as the company generates income. Other activities which impact the long-term liabilities and equity of the company are also listed in the financing activities section of the cash flow statement. Okay, now examples of cash flows. Okay, we have checked examples of now we'll see what items are included in financing cash flows. So financing cash flows include proceeds from issuing shares, proceeds from issuing short-term or long-term debt, payments of dividends, payments for repurchase of company shares, and repayment of debt principal, including capital leases. So this is about cash flow analysis. Now let's move to significant accounting policies and notes to accounts. Okay, the footnotes give a detailed description of the practices and reporting policies of the company's accounting methods, along with the disclosure of additional information that can't be shown in the statements themselves. So significant accounting policies you need to check about. First is basis of accounting, use of estimates, revenue recognition about sale of goods, interest and dividend, then fixed assets and intangible assets. Then we need to check depreciation and amortization policies, changes in accounting policies, foreign operations, and EPS, earning per share, then employee stock options, and inventories and investments. So we need to check the significant accounting policies about these variables. Okay. Now you'll ask me how to read footnotes. Okay, what to look for? The first thing is to look at the company's accounting method and how it compares to the generally accepted accounting principles and industry standards. Okay, I repeat. The first thing is to look at the company's accounting method and how it compares to the generally accepted accounting principles and industry standards. If the company is using a policy that differs from others in the industry, or one that seems far too aggressive, it could be a sign that the company may be trying to manipulate its financial statements to cover up an undesirable event or give the perception of better performance. So if you see any policy that is that differs from generally accepted accounting principles, differs from industry, and seems far too aggressive, then it could be a sign that you need to check. Okay. The second item of importance that should be examined is any changes that have been made in an account from one period to the next and the effect it will have on the bottom line financial statements. I repeat, the second item of importance that should be examined in is any changes that have been made in an account from one period to the next and the effect it will have on the bottom line financial statements. So these are two things. First is whether if the policy is aggressive and it differs from industry and looks far too aggressive. Second, you need to see from the accounting period if there are any changes in accounting. Okay. Now we'll move to notes to accounts. Okay, notes to accounts contain explanation about changes in accounting policies that we have already discussed. Then provisions, deferred tax assets or liabilities, EPS or operating leases, ESOPs or managerial remuneration, licensed and installed capacities of production, details of opening stock, turnover and closing stock, details about raw material consumed, any foreign currency transactions and any hedging or any risks related to that. Then related party disclosure, any transaction about related party disclosure. Segment reporting, if a company like HLL, Hindustan Lever has different segments, then segment reporting. And last is contingent liabilities. Look for contingent liabilities, like any case is pending against the company in the court and any liabilities or contingent liabilities payable to any firm or people. In that case, look at contingent liabilities. Then it will have a very bad impact on financial statements. All right, so this was about, in this chapter we covered how to analyze cash flow and how to read footnotes. In next chapter we will cover or will focus on director's report and management discussion and analysis and shareholding pattern.